Well, it looks like we've got a critical mass of people joining us. Hi, everyone. I'm Karen Gerwitz. Want to wish you a good morning. Although I think we have people chiming in from Germany, Nigeria, and other places as well. So it may be a good evening for you. Thank you for joining us at the World Trade Center, Denver. We are thrilled to present this presentation this morning with Amanda, who I will introduce in just a moment. But first, let me just give a shout out to PNC. They're an investor supporter of the World Trade Center, and they are an incredible resource to those who trade. They really are proving themselves to be one of the most supportive trading banks, international business banks. I think they are number one too when they work with credit insurance and XM Bank. So really, if you are looking to get some credit insurance to insure your receivables internationally, PNC is a great place to start, and they work closely with a great resource, XM Bank. So I'm delighted to have you all here today, and it's my pleasure to introduce our speaker this morning, and we can learn a little bit more about the economic outlook of global trade. So Amanda Agati is a chartered financial analyst, and she is the Chief Investment Officer for PNC Financial Services Asset Management Group. She's responsible for the firm's overall investment strategy portfolio, risk management, investment solutions, and development and execution of investment policies. She serves as chairman of the PNC Investment Policy Committee and a voting member of the Portfolio Construction Committee. She's got an incredible background, Amanda. She's also a member of the investment committee for PNC's pension fund and also serves on PNC's corporate diversity council, which I love tremendously. So PNC certified women business advocate as well. Her bio goes on for a while with her former posts and at Legg Mason, and she's got an incredible wealth of experience. Let me just mention that she does have her bachelor's of finance and economics from Penn State. She also is a member of the CFA Institute, CFA Society of Philadelphia, and sits on the boards of several nonprofits, which is also near and dear to our hearts. So Amanda Agati, you are in control of the mic and the screen now. We'd like to turn it over to you, and thank you for your time.
Well, thank you so much for that kind introduction. I am delighted to be with all of you this morning, albeit virtually. And what I thought I would do, there's no shortage of material to talk about, but what I thought I would do is try and give you some of the key themes that are top of mind for me and top of mind for the team in thinking about the investment outlook and the economic outlook. And so what we'll do is, it is not going to be a full-blown economic review because I'm very much a strategist at heart and by training and my background. And so I like to describe myself as street smart when it comes to economics. So we're not going to go deep into the theory here at all, but we're going to talk about the things that I think are top of mind in terms of gauging the market's path forward. And so we're not going to go through a slide deck. You're just going to get stuck looking at me kind of ramble through all the things that are top of mind here. But I feel like in this virtual world, sometimes it's easier to just have a conversation about the things that are top of mind than trying to go through a slide deck. So we're going to talk economy, we'll talk high frequency data, we'll talk a little bit about supply chains and inflation. I'm sure you all can probably give me a better sense of where those things are, but I'll give you my perspective. We'll talk markets, we'll talk earnings, volatility, we'll talk interest rates. And so we'll try and wrap it up at the end so there's time for questions. So let's start with thoughts on the economy. And I want to start with higher frequency data because I think that's a really important starting point in gauging the success or failure, or at least status around the reopening of the economy. As a function of the pandemic, we've really shortened up our line of sight and started tracking higher frequency data points to try and get a sense of how we're pacing this reopening, because of course we've never shut down the global economy in response to a pandemic. The markets and economies around the world have faced pandemics for eons, but we've never had quite this scenario play out. And so it may have been seemingly easy, although I don't want to make light of it, to kind of shut the lights off on the global economy definitely much tougher in flipping that light switch back on. And so gauging the higher frequency data is helpful in understanding the status of the reopening, because the usual suspects like GDP growth, industrial production, even retail sales to some degree tend to be pretty lagged and subject to a number of revisions. And so what you want to have in this kind of a scenario is really short-term, higher frequency movements to get a sense of the path forward. In quote unquote normal times, we probably wouldn't be so fixated on this higher frequency data because it can be hard to distinguish noise from signal. But I think in this scenario, it is helpful in the absence of some signaling around some of these longer cycle indicators. So when I say high frequency data, I'm talking about things like open table restaurant reservations, weekly retail sales data, public transit data for major cities that you can actually get from apps on your phone, weekly airline passenger volumes. And the idea here is we're trying to get an understanding of what the all-important consumer is doing. Are they going back to their old way of life, or has the pandemic left some lasting scars that might fundamentally or structurally change consumer behavior going forward? Spoiler alert, we do think that there are some structural changes there, and it will have important implications, particularly where the markets have rallied to versus where the underlying economy is sitting. So more to come on that. With 70% of GDP in this country tied to consumption in some way, shape, or form, it's really important to get this right. We got to fixate on what the consumer is doing to help us gauge the path forward. While the consumer in general remains in pretty, I'll call it solid shape, as a function of record high savings rates, these higher frequency data points that we're tracking do continue to suggest that the consumer isn't quite comfortable yet with returning to pre-pandemic spending behaviors. And again, I think there'll be some lasting effects of that. With the exception of retail sales, all of these indicators that I rattled off to you are still down somewhere in the 10 to 20% range versus 2019 levels. And I say that with a little bit of a lean in and a little bit of an emphasis because I'm not comparing to 2020. I'm comparing to 2019. It's not really a fair comparison to compare to basically record no activity in 2020 at the onset of the pandemic. I really want to know what happened relative to 2019 when, I don't know about you, but it was hard to fathom the idea that a global pandemic might take hold and ultimately force us to lock down the global economy. So notable that we are still not back to 2019 levels. Key message here is that I think a lot of market participants are really expecting this massive unleashing of pent-up demand, and they're pointing to these record high savings rates as the key variable. Like, surely that is the sign of this pent-up demand just ready to be unleashed into the global economy. But I think importantly, if you break it out by demographic cohort, much of the savings, maybe not all of it, but much of it is concentrated in the older age cohorts. And while I don't want to make a wild generalization, I'll do it anyway, because you can't stop me in this virtual world. But many of these older age cohorts tend not to be in highly discretionary spending mode. It isn't that there aren't pockets of it. We've certainly seen some unleashing of demand at each age cohort. But in general, they tend to be more in savings mode. And so I would say this is a little bit of a disconnect between where the consensus is today and where the expectation is today versus what we're actually going to see play out over these next few quarters and frankly years. We think elevated savings rates, perhaps not at record levels, but elevated savings rates are likely to be sustained, more the norm rather than the exception. But again, I wouldn't tie that necessarily to this massive unleashing of pent-up demand. What's also notable, this is a little bit of a segue from higher frequency data to confidence, but I think consumer behavior and confidence are very closely interconnected here. When you look at surveys like the University of Michigan Consumer Sentiment Survey, it made a new low last month, which is kind of crazy when you think about it. And when you look at the NFIB Small Business Optimism Index, so definitely bouncing off of the lows of the pandemic, but still pretty choppy and well off pre-pandemic levels. And so if there is indeed pent-up demand here in the system, It's not necessarily showing up in some of the confidence surveys that we look at. I think that's especially notable, especially considering confidence usually follows stock market performance. And up until the last couple of weeks, we've basically been sitting at all-time highs. So really strong market performance, not necessarily a leading indicator of where consumer confidence and consumer spending is likely headed. So we have a little bit of a decoupling or disconnect there. Even when you look at another higher frequency data point, it's a brand new metric that we've added to our repertoire here. It's called the Castle Back to Work Barometer, and it really tracks office usage and occupancy rates. I think it has somewhere in the neighborhood of 40,000 or more buildings across the country. It's showing an occupancy rate of just about a third. And that's really a nationwide stat. In cities like New York and Washington, D.C., it's much lower. It's more like 25% or below that. And so again, notable in terms of a disconnect between where the markets have rallied to, and in some cases, the real estate sector in particular, versus where the underlying data is sitting. I don't want you to think that I'm overly bearish here. I think it's just important to level set on where the markets are and where the economy is sitting, even at this stage of the recovery, because there are typically times where markets and economies do decouple, but more often than not, they do track each other. It's not perfect correlation, but it's a pretty high correlation. And as a function of the pandemic, we've seen this massive divergence between Wall Street and Main Street. And so key question here, and I don't have the crystal ball shined up enough to give you a perfect answer, but key question is, which one's going to hook which way? A very technical question. Said differently, the markets have rallied to such great heights. Economy is still chugging along in this recovery and this reopening. Is the market going to correct to connect down to the economy? Or is the economy going to hook up towards the market and justify the elevated valuations that are sitting in the backdrop? Or may they meet somewhere in the middle? And so I think the jury is a little bit out as it relates to which one is going to hook which way. But I think as a function of what we've seen in the market rotations and market leadership, really since the beginning of September, you have to think that this market rally is starting to exhaust itself and slow down a bit here so that the underlying fundamentals may have a chance of catching up. So I think that's an important starting point for where we are in terms of markets versus economy. I want to talk a little bit about supply chain disruptions because that's an important part of the story, and I think it will be a really key theme as Q3 earnings season kicks off really towards the end of this week and in earnest next week. And so if you look globally, COVID, for better or worse, is still very much driving supply chain disruptions as regions are in various stages of reopening. It's a very staggered effect as bottlenecks are forming and we're seeing the surge of demand coming back online. Again, this speaks to my earlier comment around seemingly easier to shut the lights off on the global economy, much harder to flip that light switch back on. Everybody's running for the same raw materials and inputs, and the supply chain movements and shipping and freighting and all of that in one shot. Inevitably, things are going to break when you have that kind of a surge in demand. On a positive note, if you look at the September manufacturing PMI survey data, really across the globe, it's not just specific to the US, it is showing an accelerating expansion. So again, survey data, not necessarily hard data, but very hopeful and optimistic that we're going to continue to see an acceleration here and that we're going to start to see some settling in terms of supply chain disruptions. We're seeing it in Europe. We're seeing it in developed markets in Asia, like Japan and South Korea and even India. But what is notable is that some of these countries are a few months behind the US in terms of the reopening process. And so again, a little bit of choppiness, a little bit of disconnect here, but some hope and optimism that things are going to start settling in here over the next few quarters. I think the biggest outlier as it relates to supply chain disruptions is really what's happening in the auto industry. Supply delays there have really yet to improve. And part of that, or perhaps a lion's share of that, is really a function of what's going on in the semiconductor industry. You think about what happened at the onset of the pandemic in the spring of 2020, companies did panic in many ways, right? They just froze. And I would say the semiconductor industry was quite a poster child for that. I'm not saying that was the wrong decision. I don't think, it's easy to say with hindsight, maybe they shouldn't have done that. But in the moment, really tough. We were in completely unprecedented territory. But the semiconductor industry just shut the lights off and did not think about rebuilding inventory. So they let inventories drain off really significantly. And so we're finding now, as they start to turn the lights back on, how much tougher it is to rebuild those inventory levels. And it's going to go on for a while. At the start of the year, I think the expectation for the semiconductor shortage was going to stabilize by Q4, or basically right around now. Today, the consensus estimate, this is by the market, when I say consensus, is the mid to latter part of 2022. And again, that's on the assumption that COVID really does become contained, and you're still seeing some restrictions in Taiwan or even Korea. And so that's certainly having a ripple effect, as 70% or more of the semi-manufacturing is coming from those particular areas. So wild card, certainly COVID. Unfortunately, I was hoping that we'd have, fully eradicated the virus by the time we had this presentation, and so a lot more hopeful in terms of the backdrop. But that's going to be a key wild card and a key governor in terms of how long it takes supply chains to normalize. The other thing I want to call out, just zooming out a little bit, so forget about just some of these very tactical things here in the short run. We have seen a lot of talk about supply chain movements away from China, right? We had globally put our eggs in one basket, that is China, over the last few decades in terms of moving supply chains to very low cost areas in China specifically. Of course, as a function of what happened with the pandemic and that being sort of the epicenter for the lockdowns, at least initially, I think there's been this global recognition that we need to right-size supply chains. And so there's been a lot of talk about movement of supply chains, but not a lot of action. And that's the trick. When you try to move supply chains, it takes a very, very long time. And so companies continue to talk about this idea of diversifying away from China-specific supply chains, but we haven't really seen meaningful movement. We do think that parts of Southeast Asia will be the key beneficiary, but unfortunately, there are not a lot of other lower cost areas of the globe where it's going to make a ton of economic sense, and to do it fairly swiftly. And so we think the supply chain discussion is going to linger for quite some time. While we think the disruption part of it may start to settle down over the next couple of quarters or so, I think this theme about onshoring or moving of supply chains is going to stick around for a while. I think the really hard, if not tough lesson that companies have learned is that they need to think about diversifying that. And so ultimately what that looks like, it's hard for the crystal ball to predict, but I think net, it's going to weigh on margins and profitability to the extent that companies are starting to invest and put dollars to work in building supply chains in other parts of the world. So an important topic that we're going to have to continue to track very closely. What's related to the supply chain disruptions is inflation. You can't have a talk about markets and the economy without talking about what the inflation backdrop looks like. And I'll say right out of the gate here, we are in the transitory camp, but that does not mean that we think prices are likely to fall precipitously. We think that the rate of change on price increases and pricing power is going to start to slow. And of course, we are starting to see that in some notable areas of the market. And so at the end of the day, the key message here, I'll talk through some of the details, but I think the key message is that we don't think that the inflation story is going to run so red hot that it's going to force the Fed's hand to make a policy decision to tighten sooner than they would like. And we don't think it's going to be significant enough to break the economic recovery that we're in. It's painful, certainly in a very acute way here over the last couple of months and quarters, but we do think that that will start to settle in as we move into 2022. So a few things I want to talk about as it relates to inflation. Well, the one is obvious, and it's really just this idea that comps on a year-over-year basis have been extraordinarily easy. We're bouncing off of record no activity. It's not just record low, it's literally record no activity. And so you're bound to see these massive comparisons on a year-over-year basis. That's why I've been looking at 2019 for the higher frequency data to really get a better sense of what quote unquote normal or quote unquote pre-pandemic times looks like. And so to extrapolate some of these really significant year-over-year moves out into the future seems a little extreme as far as I'm concerned. And so we do think that things are going to start settling down, if for no other reason than the comps are going to get tougher. And we've already started to see the comps getting tougher in the month of September. Yes, the supply chain issues are remaining, and so that is going to keep the pressure on prices and inflation metrics to a degree. But when you look at parts of the commodity markets like lumber and copper and corn, they've been on an absolute tear since the beginning of the year, but have since in the last couple of months started to fade pretty significantly. In fact, in the case of lumber, we're back below where prices started at the beginning of the year. And so notable there that we're having this big rally, this big acceleration, and then it's starting to fade almost as quickly as it's come on the scene. We think that that is really the theme and story for inflation kind of moving into the end of the year. Again, it isn't that we won't see pockets of it. We will continue to see some pockets of challenge, but we do think that the inflation story is going to start settling down a bit. The other thing that I think will contribute to a settling down of inflation readings is this fiscal cliff, or the extended unemployment benefits that expired in September will be an added headwind for inflation going forward. That's something that doesn't get talked too much about, but I think that will be a natural headwind to start coming into the equation here in the fourth quarter of the year. Another area that's caught a lot of attention, we think it's going to start fading here, is the housing market. We've seen really rapid rising in prices for the housing market. I think the July median national average home price set a new all-time high. It was up 12.5% versus 2019 levels. And so disconnect here is that wage growth is not keeping pace with house price inflation. So it's making this affordability dynamic increasingly more challenging. And so even though mortgage rates continue to sit at pretty low levels, even though policy rates from the Fed are still pinned at historically low levels, we think that that's going to start settling in because affordability is going to start to become an issue. And so while we've seen this big ramp, an injection in terms of higher inflation readings as a function of the housing market, we think that's going to start settling in naturally here as well, and will take some pressure off the inflationary fire. If I zoom out and say, all right, well, this is very specific to the US, what's happening in other parts of the world? We're not seeing the same dynamic. So China is at about plus 1% in terms of CPI. Japan is still in negative territory. Europe has seen the most, somewhere in the neighborhood of 2+%, almost entirely due to Germany and, of course, the auto industry and the challenges that are there. And so I think what's notable is that we're seeing a much easier backdrop in terms of inflation outside the US. And so to think that the US can keep maintaining this high rate of inflation would really mean, given globalization, that we're going to drag everybody up with us. I don't think that's necessarily the case. I think things are going to settle down here over the next couple of quarters and kind of meet somewhere in the middle. So I think that those structural forces outside the US will certainly exert pressure here in the US as well. The other thing that's notable from a more strategic perspective, there's still a number of forces that we think tend to be pretty deflationary. Again, aside from the next couple of quarters where we're having this cyclical rebound on the reopening, demographics, technological innovation, and even to some degree, although maybe not so much today, given how strong energy prices have been, but the supply-demand dynamics in the energy market tend to be inherently deflationary or disinflationary. And so again, while we may see, some elevated inflationary readings here over the next couple of quarters, we think those forces will continue to exert structural pressure longer term. That is, we think the inflation backdrop is going to struggle to meet the Fed's 2% long run target in general, like all else being equal, normalized. We think that those pressures will keep a lid on inflation. So important in terms of framing our backdrop and our outlook for the path forward. All right, so let's shift gears and talk a little bit about market volatility. This is where I want to segue into what all of this means for the market. So we spent a lot of time in our 2021 investment outlook talking about the idea of a high volatility regime likely being in control for much, if not all, of this year. And if the first half was any indication, the crystal ball got that recommendation right, because it has been a choppy ride for sure. Interestingly, even though there was a lot of chatter over the summer around policy changes in Washington, the market did seem to have a bit of a sense of calm. But then the minute the calendar shifted to September, it was like, boom, a shot in the arm. That was a terrible pun. As it relates to market volatility, came right back into the equation. And so we continue to believe that higher volatility is likely to be the norm rather than the exception. So larger than normal price swings are the norm rather than the exception, even though we think that markets can finish the year in positive territory. I don't want you to think that a high volatility regime means that we're overly bearish. We just really think investors need to buckle up. The policy winds of change kicking up, certainly coming out of Washington, the government shutdown debate, the debt ceiling debate, what's happening on the stimulus front, infrastructure, traditional or social, and then certainly what's happening in terms of tax policy are all coming into the market narrative at the same time. And so, we're still working our way through this reopening. And there's a lot of cross currents impacting the market. And then you throw in this wild card of Washington policy. I think it's going to be very choppy. And I think it's also a key reason why we've seen this market rally slow down. And you can't even really call a 5% pullback off all-time highs much of a correction. It really is more of a pullback, but it's very easy to see that the market would be taking a breather here, given all of the cross currents. And so buckle up. That's my key message as it relates to volatility going into the end of the year. And frankly, I think this will continue to be a dominant theme as we shift into 2022 as well. All right, so we're basically on the cusp here of starting Q3 earnings season. So I want to give you a little bit of a sense of what companies are focused on and what our expectations are. I always say where the rubber meets the road is earnings growth, and that ultimately should be the key to the path forward for the markets. It doesn't always work out that way because sentiment is a funky thing, technical term funky, and can weigh on a backdrop even when earnings growth is especially strong. But I think there are a few key themes here that are notable to share. So the first is that we're seeing this massive deceleration in earnings growth on a sequential basis. Now, again, this is not a bearish message. It's just a resetting of expectations. And I think on the part of investors, importantly so. We finished Q2 earnings season at a whopping 90% year over year earnings growth on the S&P 500. The consensus expectation for Q3 is only 27%. Now, I sort of say that with a smirk and a smile on my face because in normal times, 27% would be a home run of epic proportions, but it's always a relative game. And so I think it's important to set the stage for this deceleration, but not negative growth, certainly still strongly positive, but a deceleration on a sequential basis. And again, I think that that is slowing this market rally as investors start to reset expectations about the path forward. We're still seeing some pretty concentrated earnings drivers. Again, this has been a theme for much of really 2021. So two sectors responsible this quarter for driving the lion's share of growth. It's energy and industrial. So really telling, because those two have been the epicenter of pain for a very extended period of time. So this is their chance to get this reopening really going. The fundamentals for energy and industrials have been under extraordinary pressure. And so will be very interesting to see whether they're able to meet these lofty expectations for Q3. I would feel more comfortable about the sustainability of this market rally if the exposure, that is the contribution from earnings growth, was broader than really just two sectors. I think we've seen this price action or price reaction, this broad-based market rally come into play, but it's been very narrow in terms of the sectors and industries that have been driving it. So I think that does create a little bit of fragility as it relates to the sustainability of the rally. If it was much broader, I'd say, okay, this makes sense to have this broad-based participation. So I think we could see some pretty significant distinctions between winners and losers in Q3 earnings season. We'll see how that plays out, but that's kind of my sense right now. If I zoom out and say, all right, well, that's just one quarter. Market's a discounting mechanism. The market doesn't really care about just one quarter. It's really focused on what's further out. What are we seeing? And so earnings revisions have been very choppy over the course of this year, but they've moved in a steadily positive direction. And so earnings revisions for this year, again, on the S&P 500, just to keep it simple, are at their highest level. So we're looking at 43% projected earnings growth this year versus last year. Recall last year we finished down 14%. So we did set a low bar for ourselves, but there's organic growth to be had here in this number, this 43% growth this year. It isn't just a low bar setting expectation story. But what's notable is that the revisions for 2022 are starting to slow down pretty significantly. So again, another force that may very well be starting to come into the market narrative, slowing down this rally. So for as strong as revisions have been this year, we're looking at about 9% earnings growth for 2022. Again, all else being equal, in a non-recovery from a global pandemic kind of year, 9% would be a home run. Really positive, enough to keep this market rally fueled. But the challenge is we see downside risk to that number, and where market valuations are sitting today, where the market is priced, we don't think there's that much of a shock absorber or headroom, said a little bit differently, as it relates to valuations if we start to see numbers for 2022 come down. Another wild card, I'm going to put it out there, I know this is a tough topic, is what happens on the corporate tax rate front. So back of the envelope math, let's just say they move from 21% to 25%. They find some way to meet in the middle. Like Biden's original proposal was to go to 28%. So I'm saying let's just say base case is somewhere meeting in the middle in terms of a compromise. We go from 21 to 25% on the corporate tax rate. That has the potential to shave off 500 basis points, or 5%, to 2022 earnings growth. So suddenly that 9% is now 4 or sub 4. And again, with valuations sitting where they are, that's going to be a tough backdrop to keep this market rally fueled. It doesn't automatically mean that a market correction or a collapse or anything that dramatic is imminent. Again, don't take that necessarily away as a key message here. But it's a very important reason why we are seeing this market rally slow down, because this is starting to come back into the narrative in a real way. Again, we don't know if it's actually going to play out this way. There's a ton of debate on both sides around this, but to the extent that the infrastructure and fiscal, spending related programs do go through, the pay for is coming with it. The days of just putting stimulus into the system without figuring out how to pay for it are over. And so the tax story is starting to become very, very real for the market. And again, I think that's where we're seeing the brakes come on in terms of this rally. All right, so I've teased this out a little bit, that valuations are at elevated levels. It's not a stretch to say that market valuations are stretched. And so if you look at the S&P 500, if you look at the MSCI Emerging Markets Index, if you look at the Russell 2000 as a proxy for small cap domestic equities, they're all sitting at pretty elevated levels, 20% or more above their long-term forward PE averages. Valuations are always a relative game though, and so you have to, pay attention to them relative to the rest of the multi-asset universe, and certainly relative to what's happening in the macro landscape. And so if equities seem expensive or feel expensive, look out when it comes to fixed income. We actually think that the fixed income story is much more stretched on a relative basis versus equity markets. If you look at very simple measures like the yield to duration ratio for investment grade corporate bonds, sitting near its all-time low. It actually hit an all-time low the first week of September. When you look at the high yield bond index, the yield is just about 4% or so. On an inflation adjusted basis, that's a pretty negative yield right now. I don't know about you, but 4% doesn't seem high to me. It's sort of like just yield instead of high yield. And spreads, when you look at high yield spreads, they're at their lowest levels since 2007. It's hard to call that yield or that spread high at these levels. And I think key message here is it's not really offering much of a margin of safety for fixed income investors. We're being forced further out that risk curve to pick up just very incremental basis points in terms of yield. And so very, very challenging backdrop for fixed income investors, not only at present, but we think for the foreseeable future, it's going to be a tough slog. And when you layer on top of that, this intersection or even inflection point with Fed policy starting to fade, starting to get a bit tighter, at least in terms of messaging, I think that's going to be a very significant challenge for fixed income investors for the foreseeable future. All right, so let's talk a little bit, that's a good segue into rates, debt ceiling, and what we're kind of seeing in fixed income markets. So while we've kicked the can down the road in terms of both the government shutdown and the debt ceiling debate ever so slightly, December is going to be here before we know it. This whole dynamic feels very deja vu all over again with 2013. Back in 2013, we had a very similar setup. And back then, it actually did create pretty significant short-term volatility for both the equity markets and credit markets. In fact, in credit markets, we saw some meaningful spikes in very short-term yields. Like I think on the 1 month yield back in 2013, it went from where we are today, 4 or 5 basis points, to 35 in a matter of like a day or two. Really significant sign of stress. We're not seeing that kind of movement in very, very short-term rates here. We've seen movement to the tune of a couple of basis points higher. We've seen a little bit of an inversion in the yield curve at the very, very short end, signaling something's not quite right, but the market hasn't panicked and the market hasn't freaked out, another technical term, as it relates to what's happening in Washington. In 2013, while it created a lot of stress in markets, as Washington managed to get to a resolution, markets did shrug it off, settle down, and forge a meaningfully positive path higher here. And so I think that will be the scenario that plays out here as well. The market has seen this before. The market understands how this story is going to play out. And so again, a little bit of choppiness in the short run, but I think ultimately the market will shrug it off. What's more notable is what's happening at the long end of the curve. And it's really this idea that the market is much more focused on the fiscal spending packages, and you're really seeing it in rates. And you're also seeing it in terms of market leadership rotations here just in the last, call it, month or so. We had the 10-year break above 150 for the first time since June. The yield curve started steepening again. The 30-year went back above 2%. Well, again, a lot of choppiness as it relates to rates here. And so this is the bond market's kind of interpretation or reflection that they're thinking a lot more fiscal stimulus is coming into the market narrative again. So bond yields rising and then high growth equities selling off pretty dramatically here. Our assessment of this is that this is an overreaction, that this is in no way a breaking down of underlying fundamentals, particularly for those higher growth areas that have come under pressure in the last few weeks. It's really more of a resetting in valuations. And so we don't think that this is a new regime change. We just think this is kind of a knee-jerk reaction to what ultimately may come on the policy front. We're going to continue to watch this very, very closely, but I think it's going to be somewhat short-lived, and we'll revert to kind of business as usual over the course of the summer. That is larger caps winning and growthier oriented exposures winning here once we get past this choppy, very near-term period. Net financial conditions have tightened with the moves in some of these rates. Even though policy rates haven't moved, the market has clearly jerked them all over the place. And so financial conditions have tightened, but we're still actually near all-time lows in terms of financial conditions. So on a very positive note, very supportive for equity markets, even at these levels. But again, as I said, the low absolute yields and very compressed spreads are just going to continue to make for a tough slog in fixed income positioning. COVID, of course, remains the wild card. I mean, I think thankfully we're passing the peak of this variant, this Delta variant. We'll see what comes next. Obviously, a long way to go here. But as parts of the globe oscillate back out of restriction, we do think that that's going to help clear the path for a greater focus on the underlying fundamentals. And I do think, we'll see what happens, but we think that that may be helpful in terms of re-accelerating economic growth. So remember at the beginning where I said, which one's going to hook which way? To the extent that we see a broader based reopening in other parts of the world, that can certainly help accelerate economic growth relative to current expectations. So that would be certainly a nice positive here to keep this market rally fueled. I'm going to try and wrap all of this up because I want to make sure we get to your questions here. I think key message after I weigh all the pros and cons and headwinds and tailwinds that I've just taken you all through is that we're seeing the torrid pace of this market rally and frankly, the economic recovery start to slow down. We're passing the peak in terms of rate of acceleration or second derivative, however you want to characterize it, by many or most metrics that we're tracking. And it's on the economic side and it's also on the market side. As I said earlier, inflation, really strong readings, in fact, highest growth rate since 2008, but the comps are getting tougher and that's bringing down some of the inflation readings into the back half of the year. GDP growth for Q2 was its highest level since World War II, but second half numbers have been revised down and Q2 actually missed expectations for what it's worth. So again, right sizing in terms of expectations going forward. Even the ISM and the PMI data in the US declined sequentially and missed expectations. And so this passing of the peak idea is really kind of aligning around a lot of different metrics we track. The sentiment story clearly passing that peak, still under pressure, and even earnings growth, as we talked about earlier, passing peak, still positive by most of these metrics that we're talking about, but this slowing is starting to come into the narrative. Peak growth is not the same as no growth, and it's not the same as negative growth. So that's a key message here. It's really just a slower environment for this next phase of the recovery. And I think that makes sense. That's I don't want to say the easy money has been made in this first part of the market rally and the economic recovery because it doesn't feel easy at all. But I think we are entering this next phase of recovery where it's going to be a little bit more distinctive and differentiated by leadership and also in terms of winners and losers. And the fundamentals are going to matter a lot more, I think, going forward than just purely sentiment, which has been a key driver up to this point. So with that, let me stop there. I know that was an awful lot to throw at you, but key message, we are not bearish. We're actually feeling pretty positive about the backdrop. We just feel like we need to give ourselves a little bit of time for the markets and the economy to recouple, and then it could potentially set the stage for a very strong, very positive 2022.
Thank you so much, Amanda. I thought that was amazing how many topics you weaved in there. I really appreciate
no shortage of material to cover.
I really appreciate you weaving all the topics, especially the trade related supply chain and other things. Let me turn it over to the audience here to see who might have a question. I was hoping that you all would put it in the chat so I could call on you. But I don't see any there. Why don't I see that Alan has his hand up. Alan, why don't we turn it to you?
Yeah, hi Amanda. Thanks for coming on, and thanks for that thorough presentation. So I have a couple of questions actually, because you covered so many topics. One is on supply chain, and recently, as of yesterday, Jamie Dimon came on some comments and said that he thought that the supply chain disruption was going to be short-lived. I've heard other CEOs and COOs in logistics talk about demand softening more likely than the supply chain disruptions getting fixed. Do you agree with that? Are you in that same camp that, and I think this comports with your point earlier that despite all those trillions of dollars in deposits sitting on the sidelines and people thinking demand is just going to boom, that perhaps a lot of that is actually going to be held back, and that this demand is going to decrease prior to all the supply chain issues getting fixed, and that'll kind of balance it out. Or do you agree? Are you kind of in that same
Yeah,
thought?
I don't think that alone is what's going to solve it, but I do think that demand expectations are going to have to come down relative to what we're seeing in the backdrop. I mean, there's clearly a set of consumers that are frustrated, that want stuff that they can't actually get, right? I'm a little worried about what the holiday selling season is going to look like. That'll be the first indication of where demand is relative to the supply chain challenges that we're seeing. But I do think in general, demand is not going to live up to expectations. So that will help kind of alleviate some of the challenges, but there's a lot of other aspects to it as well. I don't think we can say, oh, demand's going to fix it. There's a lot of other aspects of this that we need to focus on. I mean, one, I'll go off on a tangent for a second, but I think the pandemic has been a poster child for just-in-time inventorying, not being, battle tested or ready for a black swan event to occur, right? And so we're feeling the effects of that. And I'm not sure that in the near future state will revert back to just-in-time inventorying. I think there'll be a scenario where companies stockpile more, maybe not substantially more, but will start to stockpile more once we get past some of these disruptions and they are able to build more inventorying. And I think that will be a smart move going forward. It will create pressure certainly on profitability just because they're going to have this higher base of inventorying. But I think that's going to be a hard lesson learned here. What I think is more concerning is just how long the supply chain disruptions go on and what that means for economic growth and earnings growth. So, to the extent that this lingers in a broad-based way beyond a quarter or two, I think it's going to be a nail in the coffin for earnings growth and economic growth in an already decelerating world. And so that's the thing that I'm most concerned about, like how systemic are some of these disruptions that even after the next quarter or two, we're not kind of solving it, fixing it, or settling them down. I don't think that's necessarily part of the market narrative yet. It'll be interesting to see. I think that it'll be a key theme, certainly on Q3 earnings calls, what companies are saying about supply chain. I'm not sure whether companies will start changing guidance on Q3 as it relates to supply chain disruptions, but that's something that's definitely on my mind. That would be a kind of keeping me up at night. It's not like a worst fear scenario, but it definitely is something that the market is not pricing for or anticipating yet. So I would kind of take it in that direction and say, what does it mean in terms of headwinds for economic and earnings growth the longer it stays around? And I don't think we have a good assessment of that yet. It's a great question.
Right.
I wish I had a crystal ball prediction for you.
And also too, if I could follow up on, you talked about labor and employment, that it's not often talked about, but we saw the JOLTS report this morning that 4.3 million people resigned from their jobs, and there seems to be this just fundamental shift.
Great resignation.
Exactly, yes. Right. So I'd love to get your thoughts a little more on that. You touched on it very briefly, but what do you think is happening out there, and what do you think that effect will have? Eventually, this just great resignation shift, getting away from hospitality jobs that we see, those sectors are now fundamentally shifting and changing to others, to finding other areas of the economy. Where are these people? Even we saw the unemployment benefits, the extra unemployment benefits fall to the wayside, and the data showed that that didn't really have any effect on increasing employment or putting people back to work. So what do you think is happening there?
Well, there's a number of things there. This is going to be a very non-scientific answer, but I think the pandemic has forced everybody to reevaluate and reprioritize the things that matter in their lives. And I think, of course, we spend an awful lot of time working, right? and so I think, of course, as a function of that, you have to reevaluate, is this what I want to do with my life? Is this what I want to be when I grow up? And are there other ways to use my talents and special gifts in a way that is more meaningful to me and is more in keeping with the flexibility that I want my lifestyle to have? And so I think that a lot of that, I think it's just a psychological thing that, there was so much time locked down. It's really an opportunity to think and reset and reprioritize. And to the extent that, individuals are able to do similar jobs, but in much more flexible ways. Not every company has embraced the idea of a very flexible, work from remote work setting. Some of them are very much like you're back in the office, like that's it. We even at PNC have this kind of arm wrestling match going on right now about what does flexibility actually look like. And so I think that's really the key to it. I think maybe the survey data, the JOLTS data from today might not fully be reflective of those stimulus benefits rolling off. So I might give it another reading or two just to be sure there isn't a little bit of that lingering effect in there. So we'll see what happens. But I think the Great Resignation is absolutely real. We're seeing a lot of turnover, record high turnover. No matter really what industry it is, it's not just concentrated in hospitality and lodging and those areas. I think what may very well solve it is something that we haven't really addressed in a very long time, and that's wage growth and the minimum wage. For everything else moving up in terms of pricing power, we really haven't seen much in the way of wage growth. It was basically non-existent for the 10 years leading up to the pandemic. And so this may very well be a catalyst for a reset there. We're definitely hearing companies talk about wage pressures and shortages around labor. And I think if you pay people appropriately, they will show up for a job. And so I think that will also weigh on profitability and margins going forward like it hasn't previously. It's not that companies are fully embracing the idea of it. I think they're just going to get to a point where they have to start making real concessions on the wage growth side to attract labor. So again, not a very scientific answer for you, a couple of different angles that we're focused on there, but hopefully that helps.
Yeah, thank you.
Thanks for those good questions, Alan. Let's turn it to Abdul Malik. Abdul, welcome.
Thank you very much for the very informative sessions. My question is about the supply chain, but there is an underlying factor that has never been discussed in the intellectual level or in academic level, which is the fundamental reordering of societies, allies, new orders, which actually can undermine or reinforce, even no matter how dynamic you are trying to resolve the supply chain. I can just give a pretty little example, just between the British and America. The British will always hold to the chest the Commonwealth model. The Commonwealth model is something, it's a dream, it's a reality, it could be, it could not. But along the supply chain issue, alliances, realliances, orders have been fundamental reordering of orders. How do we ensure that America, who is actually the all and all, the all focal point, how do we really address this supply chain issue, not just immediate and the long term, taking into cognizance the foreign policies, the reordering of societies, the new emergence order, alliance, shifting of, and all these things along that line. Like as Amanda said about the driven about basketing ourselves in China labor market, but we must think globally now. This supply chain issue can outlive us and can actually be more problematic than COVID, because there is a new world order. There is the real problem of COVID before is fundamental reordering of societies. And it might not be in the literature world, but the people are trying to, there's renaissance, there's regrowth, and everything is questioning American oligarchy, because that is truly the first and number one for now. How do we address the issue of supply chain and realliances and fundamental?
Thank you, Abdul, for your thoughtful question. Amanda, I don't know if you want to reiterate some of the things that you talked about with supply chain. I know that you're probably not in the field of solving the supply chain issue.
I wish I was. This is an existential question that you're raising here for sure. I wish I had the answer. I mean, I don't want to get too political with you all, but beyond kind of the things that I talked about, I think there is unfortunately this move, and I think it's very reflective of what you're saying, away from globalization, right? More isolationism. We've seen that play out over the last few years in terms of political stances and views, not only in the US, but in other parts of the world. And so we're definitely seeing more of that. I don't know where that will land. I'm not necessarily a policy expert, but I do think we need to find a way towards more global coordination around the supply chain, around the trade related issues that you're raising. I think you know, the pendulum has swung perhaps a little bit too far. I don't know how far it can still go, but I think we need to find some common ground and some middle ground here, because there's clearly comparative advantages, right? I'll go back to my econ days and my textbook days and say there's clearly comparative advantages for US based companies, but also all over the globe. And I think we need to utilize that diversity of comparative advantage in a much more thoughtful way than we have done historically. My hope is that if there's anything positive that comes out of this global pandemic, and it is indeed global, right? We've all been in this boat together to varying degrees and to varying severities. But if there's a post-pandemic lesson to be learned, I think it is greater global coordination than the opposite. I just hope that, I'm not giving you an answer, I'm just giving you an opinion, but I hope that this pendulum doesn't continue to swing too far, because I don't think longer term, in terms of the structure of growth and the trajectory of growth, that will be well served if we go down that more isolationist path.
And Amanda, that's music to our ears. We are a pro-globalization, pro-collaboration group, and we do try to celebrate our connectivity. So thank you for ending on that note. Sure. Just wanted to point out a few events that we have coming up. But before doing that, let me invite anyone from PNC, if you'd like to say a few words, you certainly can interject them now. Otherwise, I'll go ahead and close us out. If we have anyone on the line that from PNC that would like to speak.
Hi guys, it's Erica Rouge, and I'll jump in because I think Courtney's out right now, and I'm not going to turn my camera on because I'm sitting here in my workout clothes. Perks of the flexibility of working from home. But Amanda, great to see your face, and thank you so much for that wonderful background that you shared today. We are so appreciative of you joining, and of course to Karen and the World Trade Center for hosting us today. So thank you so much to everyone who joined.
Well, thank you very much for being such a great partner of ours and for bringing us this incredible content. Thank you, Amanda. I want to just commend all of our appreciation, bring it to you and say we welcome you back anytime. We're really given a great overview of multiple topics that are of dear interest to us. So just wanted to point out a couple things that we have coming up that might actually just carry on this conversation that we just had today. On Thursday, we are hosting a conference for our students in Colorado and beyond, as well as young professionals. It's called International Business and You. Highly recommend this conference. We've got about 7 speakers lined up for to inspire kind of how to get an international career and how to apply the nuances of trade to your career. So might want to check in on that. The other thing we have Thursday afternoon is a supply chain interest group. So for those of you that ask the supply chain questions, I hope you'll join us. This will be a practical discussion of supply chain challenges and how to resolve those challenges amongst other supply chain professionals from our network. So a really great opportunity for you to chime in and learn from others and ask your questions to your peers. I thought we also have a number of courses and other events coming up, so check our calendar at wtcdenver.org and check out what we have coming up in our calendar around training and other things. And also, if you're not a member already of the World Trade Center, I would certainly encourage you to become one. We are a growing network of international business enthusiasts. So if you are one of us, please join us. I thought I would share my screen for just the last minute of this event because I thought it was apropos. It's a nice cartoon of how supply chain is a challenge to all of us, and it made me giggle. So I thought, nice way to end. So hope you enjoy that. And again, thank you all for coming today. Amanda, you've been fantastic. I look forward to comparing notes and maybe touching base in another quarter to see if your predictions are on track. So
oh boy, yes,
thanks again.
Let's do that. Thank you,
so
everybody.
much.
I appreciate it.
Bye, everyone. Take care.